Here's something almost no retiree sees coming. The day you turn 73, a meter starts running on your retirement savings, a tax meter, and the government decides how much you have to pull out, whether you need the money or not. Frank and Carol thought they'd done everything right. They saved for 40 years, watched their 401k grow, and kept their taxes low in early retirement. Then, that meter switched on, and suddenly they were pulling out tens of thousands they didn't want, and paying tax on every dollar. It's called a required minimum distribution, and the bigger your nest egg, the louder that meter ticks. Today, I'll show you how it works, why it can quietly cost you a fortune, and the moves that turn the meter down before it ever starts. Hey there, Uncle Ray here. Grab a coffee. Pull up a chair. Today, we're talking about the tax meter that starts ticking at 73, and how to keep it from draining the savings you worked so hard to build. Let's start with the idea, because once you see it, you can't unsee it. Every dollar sitting in a traditional 401k or IRA has a little tax meter attached to it. When you put that money in, the government let you skip the tax. That was the deal. You didn't dodge the tax, you delayed it. And the government never forgets a delayed tax. So they built in a rule. At a certain age, that meter switches on, and you must start withdrawing and paying whether you want to or not. That rule is the required minimum distribution, the RMD. Right now, it kicks in the year you turn 73. From that point on, every single year, the IRS tells you the minimum you have to pull out of your traditional accounts. It's not a suggestion. It's a requirement. Miss it, and the penalty is steep, up to 25% of what you should have taken. This applies to traditional IRAs, 401ks, and 403bs, the accounts where you got the tax break going in. Your Roth is the exception, and we'll come back to why that matters. Why does this even exist? Simple. For decades, you got to grow that money untaxed. The government was always a silent partner in your account. They just hadn't collected yet. The RMD is them finally showing up to collect. And here's the part that catches people. They don't care whether you need the money. Maybe your house is paid off, your Social Security covers the bills, and you'd happily leave that account alone. Doesn't matter. Once the meter starts, you pull and you pay. So how much does the meter say you owe? It's your account balance at the end of the prior year, divided by a life expectancy factor from an IRS table. At 73, that works out to roughly 3.8% of the balance in the first year. That doesn't sound like much until you run the numbers. On $1 million IRA, that's about $38,000 you must withdraw in year one alone. And every year after, the percentage climbs, because the table assumes you have fewer years left. By your early 80s, that same table is forcing out well over 5% a year. So even if the market is flat, the meter reads higher every birthday. It is designed to drain the account faster the older you get, which is exactly when many people least want the extra taxable income. Here's the cruel twist. The better you saved, the bigger the meter reading. A retiree who built a $2 million traditional account isn't rewarded. They're handed a forced withdrawal north of $75,000 a year, stacked on top of everything else they earn. And if that account keeps growing faster than you withdraw, the problem compounds. The meter doesn't slow down as you age, it speeds up. And it rarely stops at income tax. That forced withdrawal lands on top of your Social Security, and once your total income crosses certain thresholds, more of your Social Security itself becomes taxable. So the RMD doesn't just get taxed on its own. It drags your Social Security into the tax net right behind it. One forced move, two taxes. It can get worse at the doctor's office. Medicare looks at your income, and above certain lines, your premiums jump. That's the surcharge called IRMAA. A big RMD can push you just over one of those lines, and suddenly you're paying hundreds more a month for the exact same Medicare coverage, all because the meter forced money into your income that you never even spent. If this is already making you look at your accounts differently, do me a quick favor and hit that subscribe button. It's the simplest way the folks who need this actually find it. All right. Let's get to the part that saves you money. There's one more trap worth naming. When one spouse passes, the survivor usually files as single, with lower brackets and a smaller standard deduction. But the RMDs don't shrink to match. The same forced withdrawals now land on a single return at higher rates. The meter keeps ticking, but the tax protection just got cut in half. Let's make it real with Frank and Carol. They retired at 65 with a $1.2 million IRA, and they left it completely alone. It felt responsible. For 8 years, it grew untouched to around $1.6 million. Then 73 arrived. Their first required withdrawal was about $60,000, forced out in a single year, on top of their Social Security. It pushed more of that Social Security into taxable territory, nudged them into a higher bracket, and tripped a Medicare surcharge. The account they were so proud of protecting had quietly built them a tax bill they never planned for. Now, picture the other path. Suppose that in those 8 quiet years, Frank and Carol had pulled a modest amount from that IRA each year, just enough to fill up their low bracket, while their other income was small. By 73, their balance would have been meaningfully lower, their first required withdrawal smaller, less of their Social Security exposed, and no Medicare surcharge in sight. Same couple, same savings, same spending, but one path handed the meter a big number to read, and the other handed it a small one. The difference over a full retirement can run into 6 figures. So how do you turn the meter down? The first move is the one most people miss. Don't wait. In those low-income years between retirement and 73, you have a window where your tax rate is unusually low. Pulling from that traditional account on purpose, a little each year filling up the low brackets, shrinks the balance before the meter ever switches on. Same money, but you choose the timing and the tax rate instead of letting the IRS choose it for you. The second move, if you give to charity, is a beautiful one. It's called a qualified charitable distribution. Starting at 70.5, you can send money straight from your IRA to a charity, and it counts toward your RMD, but it never shows up as taxable income. You can move well over $100,000 a year this way, and that limit rises with inflation. For the charitably minded, it's the cleanest way to satisfy the meter without feeding the tax bill. The third move ties back to something we've talked about before: Roth conversions. Every dollar you move from a traditional account into a Roth in those years before 73 is a dollar that will never trigger a required distribution again. Roth accounts have no required withdrawals for you ever. You pay the tax now on your own terms, and you switch that meter off for good on the money you convert. A few more things worth knowing. If you're still working at 73 and you don't own a big chunk of the company, you can often delay the required withdrawals from that employer's plan until you actually retire. If you have several IRAs, you can add up the total and take it all from one instead of a piece from each. And be careful with your very first withdrawal. You're allowed to delay it to April of the following year, but then you'd take 2 in 1 year, and that double can do real damage. Small details, big dollars. So let's bring it home. The three mistakes I see over and over. Leaving that traditional account untouched until 73. Treating the required withdrawal as just an income tax problem when it also hits Social Security and Medicare, and forgetting that the survivor will face it alone at single rates. The fix is the same idea every time. Act in the quiet years before the meter starts. Fill the low brackets, convert to Roth, and use charitable giving if it fits your life. You can't stop the meter from existing, but you can make sure that by the time it switches on, there is a whole lot less for it to count. Here's the honest truth, and I'll say it plainly. I'm an animated character, and this is education, not personal financial advice. Your accounts, your brackets, and your goals are yours alone. So before you make any move, run it by a qualified tax professional who can look at your actual numbers. If Uncle Ray helped this make sense today, leave a comment below, and I'll see you at the next one.